Hello, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host. Well, we had an up week in the market, but we are either at or very near a very exciting juncture. Exciting in that we're going to have potentially a very large move to the downside. And what I want to do is focus on that today. It still could be a week or two away, but we're in a zone. We're in a zone where it could happen anytime, and it has to do with the way markets move. And we've talked about this before. And basically, markets move in a patterned way that fluctuates according to a certain kind of pattern. I don't want to get into it too much, but once we've determined there's a trend change, which we pretty much have determined here. We had some highs back here. We came down and made some lows. Let me just zoom in on this and annotate it a little bit. So we had some highs back here. We came down, we made some lows. Okay, we corrected, but to a lower high. Okay, so this low here is lower. I mean, this high here is lower than this high. And then the market resumed down to yet another low that's lower than the previous low. And we're right in the middle now of a retrace of this latest move. Now, and it may go a little further. Okay, I'm kind of raising some warning flags here, but we could very well go down a little bit and then kind of retrace maybe into that area. We got the midpoint of a large candle right in here. So we've got, in fact, let me draw that as a zone instead of a line. Sometimes when you draw lines, they're a little too precise, but we got a zone there. So maybe we pull down for a week and a half, and then rally back up for a week and a half. But sometime between now and say 3 weeks from now, we're gonna hit a wall of resistance in this area, or maybe we're already there in this area, because the market did reach a high on Friday and then sell off the rest of the day. And we'll look at a daily chart to look at that. But really, for our purposes, the weekly is more telling, because we're dealing with 401ks and IRAs and things that, generally speaking, you don't drift in and out of. You're in for, if you make more than 3 changes in your 401k in a year, you're probably in it too much, in and out of it too much. So, but anyway, I just want to flash a warning here. We're very close, if not already there. We should see next week, if we see confirmation down below this 1900 area. If we get below that, that might be good enough confirmation to say that this counter trend move from this first down move is over, and we're going to be looking for some prolonged selling. And it's most likely going to be pretty scary. It's going to represent kind of like this day or this week here. Except you'll have several weeks in a row of that kind of action. So I just want to caution everybody on that. Now let's talk about where will it ultimately go. So let me pull up a 10-year chart, because I want to point out something here. This move here is a swing. Let me zoom in. So the question is, how do you know where the market's going to go to? And the market goes from swing to swing. Now you can separate out these swings here for example, these. But you can see that this one is distinct. In other words, this was kind of one move up, and then this was a move in the counter trend direction. And then if you scroll forward from here, this was really just all one move up. Okay? So once you've identified a trend change, you just want to go back and you want to identify the most important swing. Okay, in this case, right here. So what I'm telling you, and it's going to be kind of hard to believe. I don't want you to just believe me, wholesale. I mean, at the end of the day, we're responsible for our own accounts, our own money. But I want you to be prepared for a prolonged move that could take us down into an area below the 2011 low. So like this area right in here. Now, admittedly, that's scary, and that's maybe apocalyptic sounding, but that's just how the market tends to move. There's really no swing. There's no significant swing. Now, granted, it's not just going to go straight down. I'm not saying that. It'll grind its way down, and there are swings in here, lesser areas of support where the market will stop, bounce, and rally, and then roll back over. But what I'm saying is we're not going to have any kind of substantial rally until we get. I mean, the market. Here's what'll. Let me kind of slow down here a little bit. And you've got a decent swing here. Okay, so the market could slow a little bit right there, but only briefly. You got a decent swing here, so the market could slow a little bit here. And you have a decent swing here, the market could slow a little bit there. But it's really not going to turn and start going back up in a significant way, in a 401k kind of way, until we get to this swing here. And that's just the way the charts move, okay, so on a weekly chart. Now, if we look at a daily, yeah, we're going to find a lot more places where the market can turn and give us some support areas. So let's look at a 5-year chart, for example, but let's look at a daily. We've kind of already bounced off this swing low here, but you have them all down in here, right? But if you'll notice, this is all one move up. This was a little bit of a counter trend move right in here. But really, this whole move is one move up. There, you really didn't have anything very significant pulling back during this whole rally up. That's why these trend lines. That's why sometimes we'll draw these trend lines, but just to confirm what we see. If you drew a trend line and connected these lows, you really didn't get a break of that low until back here. If you take this trend line and you connect it with this one, let's just do some of that. Let's take a trend line here and connect it with this bottom here. Whoops. Try that again. You can see we broke right here. So this now becomes a significant pivot. Okay. If we take another trend line and we connect it here, see, you really don't have. I mean, you got this one that we've already kind of come down and touched. So you really don't have any kind of break anywhere along here. Even if you were kind of taking this along the way and you said, okay, well, it broke there, but these aren't huge moves. These aren't real significant moves. I mean, the reality is it just doesn't break anywhere along there. Hence, for the longest time we were talking about a rising wedge, and basically the price action never pulled back anywhere in there. So I don't want to beat that to death, but I want you to be prepared, especially if we break these lows back here at 1820 or so. You're probably not going to see, you're probably not going to feel very good until we bounce somewhere down here and maybe rally back up. But that's going to take some time. Probably what's going to happen, it's kind of interesting that it's happening during an election cycle. Probably the same thing that's going to happen to George Bush or the Republicans, it's going to happen to the Democrats. I mean, this is going to take months for it to go down here. Well, I say it's going to take months. It'll take several months, okay? So right in the middle of the election season. And probably, people are going to be upset about it, and they're going to blame Barack Obama, just like we blame George Bush. The reality is none of these guys shouldn't get the blame, and they shouldn't get the credit either. The market has nothing to do with the political environment. I know that it's not popular to say. If you go back and you look at history, Bill Clinton, people say, oh, Bill Clinton was a great president because the economy was great during Bill Clinton's presidency, or Ronald Reagan was a great president because the market was really strong under Ronald Reagan. The market was really strong, and it made them look like great presidents. That's how it works. It doesn't work the other way around. And occasionally you'll find either a great market where nothing's really, or Jimmy Carter is a great example. Jimmy Carter was blamed with a bunch of stuff that was happening in the economy and the market. But the reality is Jimmy Carter was, he was an okay president, as okay as any of the others. What had more to do with that was the strength of the dollar, coming off the gold standard under Nixon, outflows, trade deficit, and these huge economic trends, of which we're currently experiencing now. We're at the very beginning of some of these trends. So don't get too wrapped around the axle about the presidential election and what's that going to do to the market and blah, blah, blah. Just focus on the market. Don't worry about the other stuff. We look at the 10-year Treasury. I've been harping on this one for a while. We show a down week. That's a down month. Let me go to a weekly chart. We show kind of a flat week actually, and the 10-year Treasury. I was out of town all week, so I wasn't actually following any of this very closely. But what do we have? We've got a low. So the market pulled back to some level of support right in here on this midline channel, on this channel midline. And then what did it do? It rallied, it pulled back again, but look to a higher low. Okay, so I would say if next week the 10-year Treasury closes above this area right here, we might be through going down on the 10-year Treasury, and you might just see Treasuries start to continue to work their way up from here, and maybe not ever revisit this area in our lifetime. So we've got kind of a significant thing going on in the 10-year Treasury as well. The Euro-US dollar is kind of interesting. It looks like to me there's some sort of, I've got some lines drawn on here that really aren't the right kind of lines for what it looks like the euro is doing to me. It looks like the euro is in some sort of sideways triangle pattern. And let me just kind of see if I can draw it on here so we can, because right now we're kind of focused on what's drawn on there. You've got some sort of consolidation like this happening in the euro. Oops. And so I don't know if I've got enough elevation here I want to create a little bit more elevation with that line. Yeah, it's not letting me do it. Try one more time. I'm just going to draw it from here. That's good enough. Something about if the slope is not good enough, it snaps to a horizontal. Probably a setting that I need to change, but you can kind of see here we've got kind of a an up, and then we got a down, and then we got an up, and we've started a new down, and we're gonna probably have another up. And then that's going to be probably it. And then you're going to see the euro break out to the downside from here. This dotted line represents parity, I think. Maybe it was 1.05. But you're going to see the euro go, to parity, below parity. It's going to go down. So if you're into trading currencies, or if you want to take advantage of that, you might look for the euro to come into this area right around here, which is the midline of this box. So let's just let's see what that is. You might look for the euro to come around into this 1.125 area, and then sell it short, and then wait for the euro to make its way down to like a let me get on a 10-year. See, there's the problem. You got to go way back. Let's say 20 years. Yeah, to get a box below here. I'm going to move this box. Sorry. A lot of times I have some of this done, but I just didn't get around to it because I was out of town this week. But you might look for the euro to go into that box area right in there. Now, I don't think the euro is going to come back here and necessarily visit these. I mean, it could, okay. It certainly could. I mean, but it's going to have some sort of rally first, and then maybe drift down into here if it wants to revisit these lows. Obviously, the dollar is driving what's happening to the euro. So what we'll probably do here is focus more on the dollar, but. The VIX, we talk about the VIX in here. The VIX is the volatility index, and the volatility index is it's been very, very choppy. But if the market sells off, you're going to see volatility index, the fear in the market start to rise, and we'll probably take out these highs. In which case, I don't know if any of you guys are option buyers and sellers, but if the volatility index gets much higher than where it is right now, options become kind of expensive, and you're paying more for the premium. So, you want to be more of an option seller than a buyer. What's the Fed going to do? Let's look at the 13-week Treasury. Notice, I don't know, several weeks ago, we broke out of this 0.156 range. And I think I said here on the YouTube channel that the Fed was going to raise rates. And, as long as this is going up, the Fed is going to raise rates. So, we'll look at this each week, but I don't see any signs on here where the Fed might, change its mind and start, lowering rates or doing something different than what it's currently doing. So, as long as this trend line is intact, I'm expecting the Fed to raise rates. Now, what they're going to do? Notice it's 0.3, and the Fed funds rate is 0.25. So this short-term interest rate is already above the Fed funds rate, and they may let this go. They may let this lead a little further. Just because there's a lot of pressure on them not to raise rates too rapidly. So they might actually end up being way behind this curve. It'll be interesting to watch. I think normally they try to stay a little tighter with the curve, but I think politically there's going to be a lot of pressure on them not to raise rates. So we'll just see what happens. Let's play. Okay, turning to gold. What we see here, here's the long run up for gold up into 2011, and we've had this protracted sell-off, and we've been looking at this this downtrend line and these support areas. And if you recall, I mean, really overall this time I was saying, anywhere in here is a good time to be a buyer of gold. And we talked about, how do you buy gold? Do you buy the GLD? I mean, if you're going to trade gold, you can trade the GLD, which is like an ETF for gold. But if you're buying gold to, hedge against loss in purchasing power at some point in the future, you really need to have physical gold. You need to actually own coins or bars, whatever coins are good because the value of the coins is well known. There's markings on it that makes it easily identifiable. Same thing with silver coins. Gold bars, how do you get change for that? That's one of the problems there. But anyway, gold is clearly in the throes of a rally here. I'm expecting gold to probably get up into this 1300 area before it pulls back, and the pullback could be substantial. It could be down here into the mid 1100, 1150 area, and then you see gold run up to around 1500, 1550. I've got a 1531 marks this series of lows right in here where gold came down a couple times, rallied, came down, rallied, came down, rallied. This is probably a good resistance area to focus on for gold, but we've got a pullback. Well, first we got to run up in our future into this low 1300 area, 1320 maybe, and then we've got a pullback, and then we're gonna have a run up into this area. So if you're still looking to buy gold, you might want to wait until after we hit this high here, and then we pull back a little bit. We'll be talking about gold in here, and silver is the same thing. If you're focused on gold chart, the silver chart, silver and gold pretty much move together. We can look at silver. We haven't spent a lot of time talking about silver in here, but same kind of thing. You can see all these little bottoming. In fact, let me just zoom in because I'm not sure you can see them. You can see how just silver just right around this support area that we had, and then boom, took off. And so all through in here I was talking about this is a good place to be a buyer of gold. Now silver's pullback's a little deeper. Silver's a little bit more volatile in general, so I'd still look for silver to run up into maybe a little higher. Let me draw that again because I really don't have the right location there. I can't tell if there's a high there. Let's just go off this high. But what you want to do is it tends to move just beyond the previous pivot. So here's a pivot, and then the market went down, right? So we tend to move just beyond the pivot, and then we'll get some sort of pullback, that looks like this, probably into this area here, and then you'll have silver probably rally into something around this area right in here, somewhere right in here like so. So after we pull back, then you'll get silver running, zigzagging its way up into this area. But we're in the bigger picture is we're in a long-term bear market for commodities. You actually can see silver, again, you can see these lows here, the low here, rally up, pull back to a low, rally up, pull back to a low, rally up, pull back. So let's draw a line here for silver that we can focus on that connects these lows here. I think that's a good target for silver before we roll over and start going back down. So we'll see how that plays out. But a lot of times, when you have this kind of overhead resistance, it usually ends up being resistance when the market comes back up there if you're in a downtrend. So, which I believe we are in a downtrend. So anyway, let's look at the dollar. You can kind of imagine what the dollar might look like since we've already looked at the euro and we've and we've looked at gold and silver. We're looking for, oh, that's not working out. We're looking for the dollar to pull up into this area right here. Probably as gold, pulls back, the dollar will pull up into this area. And then as gold rallies again, the dollar will pull back, and so on and so forth. But there's other plays, there's other things going on with gold, so you can't just look at the dollar. But certainly there's a lot of strength left in the dollar as these other countries do, monetary printing and all kinds of negative interest rates and things like that. Money is flowing out of those countries and flowing into the United States. Now, ultimately, money is going to reverse and flow out of the United States and into some of these other places. But right now, it's flowing into the United States. Thus, the dollar is strengthening. Let's look at NinjaTrader and look at oil. Not much has changed. This is not a current oil chart. Let me probably should have checked this before I. Well, let's not look at the euro chart and pull up an oil chart. Problem is we're getting close to the end of the February contract. Yeah, so here's oil. Let's look at a monthly, so you can see a little bit of the bigger picture. You can see here there's a pretty big wave pattern going on here. If we click L8 wave, click this right here, you see we're in some sort of larger degree wave 3, and it's probably this whole thing. This is probably 1, and this is all 2, and then 3. So let's try that. Let's do down wave 3. Start right here, go to here, and then to here. Yeah, and so you can see here that we're probably nearing the end. I mean, this is the typical wave 3, this pink box here. Somewhere in here there's a fourth wave in our future. And then, probably prices will go lower. After you have a fourth wave, there's a fifth, right? So at some point we're going to have a rally, maybe up into this area, around 50, 59, this point right here. Right about where the trend reversal, this is the stop for a trend reversal. If your trade, it's like a true range, average true range. And then, once we hit that, we'll probably start coming down on oil again, and probably won't break the old lows of $9.99 or whatever it was, but we could get below $11 or $12 before oil stops going down. So unfortunately for people in the oil business, things are not looking so great there. It's good for consumers, but bad for people who have jobs in those industries, and especially those people that have a lot of debt in those industries. The folks that borrowed a lot of money to start a drilling company or pipeline company or whatever, those companies are in a pretty bad way right now. So, the S&P 500 is where I focus a lot of my attention. And just to recap, now that we're on a daily, this could have been the move. It's not likely to be finished here. We're probably got, my guess is we have another 2 to 3 weeks, but you could see next week actually come down here and make a slightly lower low than this, and then we could rally up a little higher, maybe even up to that gap. It's possible. There's a gap back here, and then we got a nice little ABC correction that pretty much portends a lot of selling. So be careful, pick your place, don't feel regret if you pick too early. If you want to wait to see If we bounce from here, that's probably not a bad thing to do, and see if you can get a little bit more price action at the top. But if we start getting close to that gap, or even even around 2,000, it's probably smart to step to the sidelines, let this freight train come barreling down the tracks, and you are sleeping soundly in your bed at night, not worrying about a thing. That's how that goes. All right, everybody, that is it for this week. I want to thank you for coming in and spending time here. You know, I realize you're out there and you're like, I don't know if this is true or not, but I'm watching closely, and that's fine. Gathering evidence, but as evidence gathers and you see what I'm saying is working, make sure you share it with your friends and family. Look, when you retire, you're going to want to have somebody to go travel with and go do things with. If all your friends and family members are broke because they stayed in the market during the worst bear market since the 1920s, you're going to be traveling alone. You're going to be doing stuff alone. So don't let your friends suffer through that, okay? All right, everybody. Take care. Bye-bye.